Okay, we are now coming to that part of modern portfolio theory that is typically the most challenging for students, and that is multi-factor models. But this is really important for people who want to go into the field of being able to manage portfolios, to be investment managers. And the reason why is because most investment managers have to come up with a decision. Is a stock undervalued or is it overvalued? Well, how do you determine whether the stock is undervalued or overvalued? Well, what you have to do is you have to have an idea of what its value should be. And so if you've calculated what the value should be, and then you look at what the value is, what the price is, then you can determine if it's undervalued or overvalued. Well, how do you determine what the stock price should be? You need an asset pricing model to be able to do that. Now, most of your investment managers have proprietary asset pricing models, meaning that they developed themselves and they don't share it with anybody else because that's kind of their the thing that differentiates them from others and they feel gives them a competitive advantage. So you can't just say, well, here are the typical asset pricing models that everybody uses. Certainly the capital asset pricing model has been used for a long period of time. And the Fama-French three-factor model is used quite a bit as well. And so because they were developed by academicians, and they're out there and they're in textbooks and so forth, we're going to use them. We have been using the capital asset pricing model, and we will be using the Fama-French three-factor model. But we can't just go to professional asset investment managers and say, tell us your secrets. I've got a friend who's a very good chef who's known for making a certain seafood casserole. And I asked him one time, what's in it? He said, I would tell you, but then I'd have to kill you because it's a trade secret and I don't tell anybody what is in this because that's my bread and butter. I sell that thing. So it's the same way with the investment managers. So what we're going to do now is we're going to get a good understanding of what is meant by multi-factor models and how they in general work. Then we will look specifically at the Fama-French three-factor model to be able to come up with an expected return on assets. So we're going to go look at the notes that are titled multi-factor models, and I'm going to bring that up now to be able to go through it with you. Okay, so you should be able to see that. And this starts off the same way as we did with our single factor model. Okay, it said that for our single factor model, the return on stock I was equal to the was the actual return, R sub I, was equal to the expected return plus the sensitivity to the factor, the one factor in a single factor model, plus an error term. And we, not an error term, but it's going to be the effect that is just going towards that particular stock, not a not a macro effect, but a firm specific effect. So at any rate, what we have, what we did with the capital asset pricing model is we said that the excess return on the market was the one factor, that was F. And the betas we were calculating in the CAPM is the stock's sensitivity to that factor. And obviously not every stock has the same sensitivity to that particular factor. We did Amazon and it was 1.4 something. We could do other stocks and find out what their sensitivities are to the one factor. Well, in a multi-factor model, we're saying, hey, there's not just this one thing that affects the returns on a stock, okay, and being the market. There are other things as well, and different investment managers will have ideas about what are the other factors that should be used. So let's, and this is not something they just figure up in 5 minutes. They may spend months or years doing research and giving a lot of thought to what factors to put together into a multi-factor model. And you might say, well, let's just put as many factors in there as we can possibly think. Let's do 120 factors in there. Well, in econometrics, which is kind of advanced statistics, there is something called multicollinearity, which says that if two of the factors are very highly related to each other, you end up getting bad results. So these whatever factors you put in, they're not supposed to have any significant relationship. In other words, the correlation between any two factors should be as close to zero as possible. It doesn't have to be exactly zero, but it should be in that neighborhood. Okay, so that makes it tough, and it makes it so you're not going to have 100 factors in a model, because you're very likely to get two that are very closely related, and then you're going to get bad results. But it's not unusual to see 10, 12, 13 factor models. I've seen some professional investment managers who have put together 12 factor models, and they've kind of danced around what were the factors that were in there, but without being real specific on it. I've had them come in and speak to my classes a couple of times. But at any rate, we want to remember that the capital asset pricing model is a one factor model, and the one factor is R sub M minus R sub F, the excess return on the market. So that would be the capital asset pricing model. Let's assume that we want to have a two-factor model, and suppose we want these two factors to be unexpected changes in gross domestic product and unexpected changes in interest rates. Now, notice I'm saying unexpected changes. In any type of a factor model, what you want to say affects the returns on something is something that happens that was unexpected. If something happens exactly as expected, it's not going to affect returns on anything. It's going to be, well, this is exactly what we expected. We had it already priced in. So, and this actually makes things challenging, because if our two factors are going to be unexpected changes in gross domestic product and unexpected changes in interest rates, we got to first know what the expected change is. We have to have some way of being able to measure what was expected. Now, this actually, in many cases, becomes problematic. Okay, when we were talking before about unexpected changes in oil prices. Okay, if the oil price goes up by $10 unexpectedly, and something like that. Well, we have to have expected changes in oil prices to be able to come up with unexpected changes in oil prices. Well, how do we know what the expected value was, and does everybody have access to that information? Well, we're gonna see how we get around that in a little bit by building what we call factor portfolios, and more specifically, some self-financing factor portfolios. But for right now, let's just accept that our factors are going to be unexpected changes in things. And we're going to give an example of a two-factor model where it's the two factors are gross domestic product and interest rates. So let's go to our back to our notes on that. Okay, and we'll scroll down to where we have this. Okay, so what we're going to do is we're going to say that the expected return on a stock, whatever stock we want to look at, is going to be equal to the risk-free rate, just like we were starting with the one-factor model, the capital asset pricing model, plus the beta for GDP. That is your sensitivity to changes, unexpected changes in gross domestic product, multiplied by a risk premium for GDP, plus a beta, a sensitivity to interest rates, times the risk premium for interest rates. So what's a risk premium? Well, remember the risk premium in the capital asset pricing model was the market risk premium of 5.7%. It was the extra return you get for taking on the risk of the market. Well, same thing is going to be true here. The risk premium for GDP is going to be the extra return you get for taking on the risk of GDP. and the risk premium for the interest rates works the same way. But it's going to be a little bit different. Sometimes these risk premiums will be positive, and sometimes they can actually be negative. In fact, we'll see that, I think, for interest rates, that we'll see a negative risk premium for that. And how about sensitivities? The beta in the CAPM measured your sensitivity to R sub m minus R sub f. That was what we found through the regression. How sensitive you are. If, in other words, if the market goes up by 1%, Amazon tends to go up by 1.4%. The market goes down by 1%. Amazon, on average, goes down by 1.4%. Well, a beta for GDP would tell us that if GDP unexpectedly goes up by 1%, how much does Amazon, or how much does the stock go up by or down by? So if we have a beta for GDP that was equal to, let's say, 2, that means if GDP goes up by 1%, the stock typically goes up by 2%. GDP goes down by 1%, the stock typically goes down by 2%. While a negative beta is very, very rare in the one-factor CAPM model, a negative beta is not necessarily so rare in a multi-factor model. Let's look at interest rates, for example. Typically, if interest rates go up, most stocks go down. Not all of them, but most of them do. So if interest rates go up, a lot of stocks would go down, meaning that a typical stock would have a negative sensitivity. So this beta for interest rates, it's not too unusual to see that being a negative number with respect to interest rates. In fact, if it's a positive number, that means if interest rates go up, typically the stock goes up. And if interest rates go down, typically the stock goes down. So what we see as typical in the CAPM is not necessarily always going to be typical in a multi-factor setting there. So let's suppose that we have done a little bit of work and we have come up with a risk premium for gross domestic product. And how we come up with these risk premiums we'll talk about later, because it's a little bit more complex. We've come up with a risk premium for gross domestic product as 6%, kind of like we did with the 5.7% for the R sub m minus R sub f in the CAPM. And we've come up with a risk premium for interest rates as negative 7%. You can get I mentioned this before, you can get a negative risk premium in a multi-factor model. In fact, you will have a negative risk premium if the typical beta is negative, if the typical sensitivity is negative. So what does this mean? Well, let's suppose that we run some tests and we find out that our stock has a sensitivity to GDP of 1.2, meaning that when GDP goes up by 1%, the stock typically goes up by 1.2%. GDP goes down by 1%, the stock typically goes down by 1.2%. And we've got a beta to interest rates of 0.3. Now, this is a little bit unusual to have a positive beta with respect to interest rates. But it means that if interest rates go up by 1%, the stock typically goes up by 0.3%. If interest rates go down by 1%, this stock typically goes down by 0.3%. That is its sensitivity to that factor. So if we want to calculate the expected return on this two-factor model, it's really not that difficult. It's very similar to with the CAPM. We say the expected return is equal to a risk-free rate, which is going to be what is the current risk-free rate, 3%. Plus your sensitivity to changes in GDP multiplied by the risk premium for GDP, plus your sensitivity to changes in interest rates multiplied by your risk premium for interest rates. Now notice, when the risk premium for interest rates is negative and the sensitivity is positive, that's overall going to be a negative, okay, which is going to lower expected returns, which happens when stocks are considered to be different from normal. They move opposite what you typically would see, and therefore investors like having them in their portfolio because it brings more diversification and thus lowers the risk. So remember, we said typically if interest rates go up, typically a stock goes down, right? In this particular case, this stock has a positive sensitivity to interest rates, meaning it does different from the norm. Typically, if interest rates go up, most stocks go down. But with this stock, if interest rates go up, it goes up. So investors like having stocks like that in their portfolio because it's further diversification. It's going to have low correlations with the other stocks, and it's going to bring down the standard deviation of the portfolio. So if they like having them in there, then they are willing to accept a lower rate of return in there. And so that's why the 0.3 times the -7 is going to be a negative component that is going to end up having a lower expected return than it otherwise would have. However, with GDP, we have a positive beta, and most stocks go up when GDP goes up. So therefore, we are requiring a higher rate of return as compensation for stocks that do the typical thing. Stocks that do the typical thing, we require a higher rate of return as compensation for holding them in our portfolio. Stocks that do something unusual, okay, that would have a low correlation with the other stocks, we are willing to accept a lower return. So that's the basic that's the basic idea here, okay? Now, how do we measure these betas here for this? Well, we have to do it the same way that we would measure betas for the CAPM. We have to look at historical data and find out how sensitive is the stock, or at least how much it has been in the past, to these unexpected changes. And we do it through a linear regression. But as I mentioned earlier, the challenge with this is how do you go about finding, okay, what was expected, and sometimes how do you even go about finding the data in terms of changes in interest rates every single month if you're going to try to do that, because maybe the changes in interest rates only come out once every quarter or once a year or something like that. So there's a way to get around some of these difficulties, the difficulty of getting a risk premium, the difficulty of finding these things. And that is by putting together factor portfolios. So that's going to take us a little while to get into. So we're going to do that with another video where we talk about factor portfolios.